get returns without the risk. Understanding the market. The risk-free rate. The risk-free rate is just what it sounds like. It's return that can be achieved without taking any risk. All other rates of return, such as those investing in stocks, are built off of this foundation that is the risk-free rate. As a generalization, you gain more expected return the more risk you take on above this risk-free rate. So what is the risk-free rate? It's generally accepted to be the rate of the Treasury bill, or T-bill. The Treasury bill is the short-term, less than 1 year, government bond issued by the Department of the Treasury. Through historical data, we can see that it has averaged to be between 0 to about 2%. Remember, when we buy bonds, we are lending money out in exchange for future returns. When you buy a government bond, you are giving the government money and you're expecting them to pay you back. And in terms of T-bills, it will be an average of 0 to 2% return on the money that you paid for that bond. But what makes this bond risk-free? All Treasury bonds are backed by the full faith and credit of the United States government. That means if for some reason the government does not have the amount of cash needed to pay you back, they can simply print or borrow more to do so. Understanding the risk-free rate is a prerequisite to understanding more complex financial ideas. This is a foundation to build off of in the future. That's all for today. If you like the video, make sure to like it and sub. See you guys next time.